I spent $250,000 tokenizing a rental house on Solana, and the moment I tried to actually sell my tokens, I discovered a catch that nobody in the RWA hype machine talks about. It took me 47 days, 3 lawyers, about $11,000 in fees, and one very confused county clerk to learn what I'm about to tell you in the next 10 minutes. So if you've been seeing the headlines, BlackRock tokenizing funds, Boston Consulting Group predicting a $16 trillion tokenized asset market by 2030, and you're wondering whether you should put your house or your savings into real-world asset tokenization, watch this whole thing first. Because the technology is real, but the catch is also real and it's not the one you're expecting. Let me set the table. RWA tokenization means taking a physical or traditional asset, like a house, a bond, gold, a piece of art, and creating digital tokens on a blockchain that represent ownership or a claim on that asset. The pitch is gorgeous. Instead of needing $250,000 to buy a rental property, you buy a $50 token. Real estate becomes as liquid as a stock. You can sell at 2 a.m. on a Sunday. No realtor taking 6%. No 45-day closing. That's the dream the industry sells, and companies like Securitized, Realty, Lofty, and Ondo Finance have raised hundreds of millions on it. Ondo alone manages over $1 billion in tokenized treasuries. So this isn't vaporware. I want to know what it actually feels like to do it with a real house. So I bought one, a modest 3-bedroom rental in a mid-sized market, and put it on chain. Here's everything I learned point by point. First point, and this is the one that breaks most people's mental model. You cannot actually tokenize a house. You tokenize a company that owns the house. This is the single most important thing to understand. So let me slow down. When I tokenized my property, what really happened is I created a limited liability company, specifically a Wyoming LLC, because Wyoming has the friendliest laws for this. And that LLC took title to the property at the county recorder's office, on paper, with ink, the way it's been done for 200 years. Then I issued digital tokens that represent membership shares in that LLC. So when you buy a token, you don't own a brick of my house, you own a fractional share of a company whose only asset is the house. Why does this matter? Because every legal protection, every tax consequence, every risk you take flows through that LLC structure, not through the blockchain. The blockchain is just the cap table. If you're evaluating any RWA project, your first question should be, what's the legal wrapper and where is it domiciled? If they can't answer that crisply, walk away. Second point, the chain you pick is a real financial decision, not a vibe. I chose Solana, and I'll tell you why with actual numbers. When you have a property paying out rental income to, say, 200 token holders every month, you're doing 200 micro transactions on Ethereum mainnet at busy gas prices. Each of those distributions could cost $5, $10, $15 in fees. Multiply that across 200 holders 12 times a year, you could burn thousands of dollars just moving rent around. On Solana, those same transactions cost fractions of a penny. My total monthly distribution gas cost was under $1. That's the actual reason institutions are looking past Ethereum is more decentralized. When you're running income-producing assets at scale, transaction cost compounds. The actionable takeaway: for high-frequency, low-value distributions like rent or dividends, low-fee chains win. For a one-time, high-value transfer, the fee matters way less. Match the chain to the cash flow pattern. Third point, compliance is the wall everyone hits, and it's where the dream of 2 a.m. liquidity quietly dies. Here's what happens. So those LLC membership tokens, in the eyes of the US SEC, they are almost certainly securities. They pass the Howey test. You're investing money in a common enterprise, expecting profit from someone else's efforts, namely me managing the rental. And that means I can't just throw them on an open exchange and let anyone in the world buy them. I had to use a Regulation D exemption, which in practice limited my sale to accredited investors. I'm under there for people with a net worth over $1 million, excluding their home, or $200,000 in annual income. and every single buyer had to pass KYC and AML checks before a token could land in their wallet. So, those tokens have whitelisting built into the smart contract. They literally cannot transfer to a wallet that hasn't been approved, which means the sell instantly to anyone fantasy is gone. You can only sell to other pre-approved accredited investors. The actionable lesson: when a tokenized real estate platform promises liquidity, ask liquidity to whom? Often the answer is a tiny pool of vetted buyers, which is not liquidity at all. Fourth point, the Oracle problem, or what I call the who says it's worth that problem. On a pure crypto asset, the blockchain knows everything about the token because the token is the thing, but my house lives in the physical world. Did the tenant pay rent this month? Did the roof get damaged in the town? In the storm? Is the property still worth $250,000, or did the local market drop 10%? The blockchain has no idea. It depends entirely on a trusted party and can merge me or a management company or an appraiser. So to input that data honestly. This is the Oracle problem, and it's the dirty secret of all RWA. You are not trusting math anymore. You're trusting a human to tell the truth about the real world and update the chain. So every trustless marketing claim about tokenized real estate is at the core false. There's always a trusted middleman reporting reality. Before you buy any RWA token, find out exactly who reports the data and what audits hold them accountable. If it's just Taqwa, the project team, trust us. That's a major red flag. And the fifth one, okay, I saved it for the end because most people genuinely don't know this yet, and it's the one that cost me the most sleep. When you tokenize ownership and sell shares to hundreds of people, you create a brutal governance problem. What happens when you need to actually sell the physical house? Picture it, the real estate market is hot. It's the perfect time to sell. And a buyer offers $300,000, a great price, but the house is owned by an LLC with 200 token holders scattered across the globe. Selling the physical asset requires a vote. Now you have to coordinate hundreds of anonymous wallet holders, hit whatever quorum your operating agreement demands, and get them to agree in time to accept the offer. Some are asleep, some lost their seed phrase. Some are speculators who want to hold for more, some just never check their wallet. Meanwhile, your real-world buyer has a 30-day window and walks. This is the fractionalization paradox. The very thing that makes the asset liquid as tokens makes the underlying asset incredibly hard to actually sell. I had a clause requiring a 66% vote to liquidate, and during a test run, I couldn't even get a quorum to respond in 2 weeks. That's the catch. Tokenizing a house doesn't make real estate liquid. It just moves the illiquidity from the property to the decision making. So let me bring this all together with the deep dive, the thing I wish someone had told me before I spent 11 grand. RWA tokenization is not a scam, and it's not magic, it's a BM. Is this casa ne paspau Kurdur tool with very specific best uses. Where it genuinely shines right now is not janky retail house flipping. It shines in tokenizing things that are already standardized and already income producing with clean data, US Treasury bills, money market funds, investment grade bonds. That's why Ondo, Franklin Templeton with its Benji fund, and BlackRock with BU Idol went straight for treasuries and not single family homes. The data is clean, the asset is fungible, the regulatory path is clear, and there's no roof to fix. For a single rental house, the tokenization overhead, legal, compliance, Oracle reporting, governance often costs more than just owning the property in a normal LLC and selling it the old-fashioned way. If you're a regular investor wanting real estate exposure on chain, you're far better off buying tokens in a large, professionally managed, diversified, fully compliant fund than buying a fraction of one specific house from a small platform. And whatever you do, before you put $1 in, read the operating agreement, find the legal wrapper, identify the data oracle, and ask exactly who you'd be able to sell to. Those 4 questions will protect you from 90% of the garbage projects out there. The tech is the easy part. The structure around it is where the money and the risk actually lives. If this gave you an edge, smash that like button, subscribe to Alpha Protocol for your daily drop on AI, crypto, and finance, and drop a comment. What do you want me to break down next? I'm thinking about tokenizing my car title next, just to see what breaks. Let me know if you want to see it. So, om video sends my fa sen